Hey, welcome to our math review. I'm excited to be here. I hope you are too. We're going to work some math problems, but first I'd like to reassure you that I know that some of you are math phobics. I mean, it's just you can't even, in fact, there was one lady that I told her, the math is no big deal on the test, maybe only 8 questions. Anyway, she flunked the exam and she called me and she said, Roller, you lied to me. Every question was math. And I said, what do you mean every question was math? That's totally impossible. She says, no, every question began with a number 1, number 2, number 3. Worst case of math phobia I've ever seen. Well, hopefully you're not that bad, because tonight we're going to work through some problems that are going to be very, very helpful to you in getting through this test. And so stick with me. First of all, we're going to look at a question. We're going to examine that question. We're going to look to see what is the answer they're looking for. What are we trying to solve for? And then we're going to extract the information we need out of that for our evaluation. After we look at a formula, it's just going to be really simple. So we're going to go through these rather quickly. Hope that it works well for you. And if it doesn't, well, I don't know if we can overcome 20 years of poor math skills in one 45, 50-minute program, but we could certainly get you to a point where you can get these math problems correct, okay? So let's dig right into it, okay? All right, with our first question, M's home has an appraised value of $380,000. If the assessment rate is 60% and the tax rate is 7 mils, what will a tax bill be at the end of the year? Obviously, what we're solving for here is this is a tax problem, isn't it? That's what they're trying to come up with. What will their tax bill be at the end of the year? Obviously, this is property tax, and we know there's an assessment rate. So what numbers do we need in order to make this work? And what is the equation we're going to put them into? This is the equation you need to know for tax bills. The appraised value times the assessment rate gives you the assessed value, times the tax rate gives you the tax due. Now, they're looking for the tax bill or tax due, and that's on the bottom of our formula. Well, that's great, because this is the formula you need to know. And some people remember this if you're a poker player with a full house. We've got aces over tens, 3 aces over tens. I think that's a pretty good winning hand in poker. But anyway, the point is, let's look, what is the appraised value? Let's highlight that. Okay. And what was the assessment rate? 60%. And then what we need to solve for, of course, is the tax rate, and that'll give us the tax due. Now, write this on your paper. Write 0.001. 0.001, because decimal point 001 is 1 mil. See, 1 mil is 0.001. So what would 7 mils be? 0.007. So let's put the numbers in this equation. We'll just do it right off to the side here. First of all, the assessment, the appraised rate, the value, the appraised value they came up with is $380,000. Now, they just gave you that in the question, right? And then the assessment rate was 60%, right? Right. Now, you see how in a percent sign, there's 2 little zeros, there's a 0/0. Well, that tells you that to take a percentage like 60% and convert it into the decimal equivalent, you just start over on the right hand side and you move that decimal point, if there was one there, imaginary, you move it over 1, 2 places. So 160% would be the same thing. You take the percentage 00, move it over 1, 2 places, only it would be 1.60, but this is 60%. So you only have to go over the 2 places and it's 60%. Now, if we take that figure of 380 and we multiply it by 60% or 0.60, we come up with the assessed value. And we're just following the formula over here on the left-hand side. Now, the tax rate was 7 mils. And remember, 1 mil is 0.007, 0.00. So 7 mils will be 0.007, okay? And then once again, it's multiplication. And that gives us a tax due of $1,596. And we look at our problem, and that's answer B. And that's as simple as it gets. Now, a lot of times what happens on this is they'll give you an upside down and backwards thing. They'll say the tax bill was $1,596. It was 7 mils, and it was a 60% assessment rate. What was the appraised value? Well, if you're working from the bottom up, then you divide. So those multiplication times would change into division, and you divide 1596 by 0.007. That would give you 228,000 or 228,000. You divide that by 0.60, and that would give you 380,000. So you can work it backwards or forwards. Now, this is a very straightforward math problem, and a lot of them are this way, but a lot of them might give, as we work through this tonight, sometimes you have to do something to manipulate the numbers in order to get the numbers you need to throw into the formula. This one, we didn't have that. We just took the numbers right out of the question. They were just what we needed, and we just ran it. The only thing you really had to extrapolate on this one was knowing that 7 mils is 0.007, because 1 mil is equal to 0.001. So 10 mils would be decimal 0.010. Okay, that's what you got to remember in order to do this. Plus, you have to remember the equation. So go to the next problem, please.
Just to remind our students, we've got a link to these questions. If you didn't already have them, if you just click the link, you should get a PDF of the questions, and I'll post a link to the answers too, but you can work them through with us.
Yeah, that's great. That's super. Let's look at the next question, please. That's the way you need to do it. Okay, now Jay paid $675 in property tax. If the tax rate is 2 mils and the assessment rate is 75%, what is the appraised value of the home? Okay, so what are they looking for now? Well, they're looking for the appraised value of the home. That's the answer we're looking for. Now, from the discussion I just had with you a few moments ago, this is the same formula, only it's upside down. Okay, so what is the appraised value of the home? All right, so see, in our previous example, the tax due was on the bottom of the formula, wasn't it? But this one, we're working it backwards. All right, so what is the other data we need? We need the 675 for the tax due, we need the 2 mils, and we need a 75% assessment rate. So let's plug our figures in now. We know the tax bill due was the $675. We know the tax rate was 0.002, because 2 mils, that's what it is a decimal equivalent. And the assessment rate was, and what happens here is we divide the one, the 675 by 0.002, and that gives us 337.5. And then we have the assessment rate, which was 75%, which the decimal equivalent of that is 0.75, right? 75% of a dollar is 3 quarters, right? 3 little silver quarters, which aren't silver anymore. But anyway, that would be 0.75 cents, wouldn't it? Don't freak out on this stuff. Just kind of think it through. And now we have to make one more division, don't we? We have to divide the 337.5 by the 0.75, and that gives us the appraised value of 450. Then we look on our answer sheet, and that's answer D. It's just that simple. So what do you got to know? Well, on these tax problems, you got to know that the formula works up and down, and you can move the formula kind of reverse. If you're doing the last thing, which is the tax due, it's going to be divide. But if you're starting with the appraised value, then it's going to be multiply. Okay. And just work a few of these, and I'll think you'll have them. The great thing about the math problems is, and there'll probably be about 8 math problems on your test, maybe plus or minus 1 or 2. But the wonderful thing about it is, if you just learn these simple formulas and you work these, that's 8 you're going to get right for dang sure. But on the other hand, if there's 80 questions, because the math is primarily on the national portion, and you only need a 70%, that means you could lose 30, you could miss answer 30 questions or miss 30 questions. Well, 30% of 80 questions is how many questions, my friend? Take out your little calculator and figure it out. but you could miss over 20 questions and still pass the exam. So you can miss all the math. I would rather you got it all right. So let's pay attention. Let's move to a new set of questions now, because now we're going to be talking about capitalization rate. Now on the exam, cap rate could be called capitalization rate. It could be called cap rate, but quite a few times they call it rate of return. All those three things mean the same dang thing. They're all cap rate problems, okay? So let's look at this one. Kay has an investment property that they would like to list. And they currently earn $10,000 per month in rent, and they have expenses of $5,000 in maintenance and $300 in tenant improvements. At a cap rate of 6%, what would the listing value of the property be? Now, the key here is if you're, well, that's what we're solving for is a listing value. What are we going to put it on the market for? Well, the best way to, income property is primarily priced according to the income that comparable properties would also, that are like the subject property would have actually sold for. And so, you can get all the information on what it's sold for. You can get the information on what the expenses were and what the income was. And then what happens is if it was truly comparable to the subject, they should sell for about the same cap rate. And so to get cap rate, you can try to get that information. You can get it, in a number of different places. But the best way to understand cap rates and gross rent multipliers and to get the numbers quickly are to befriend appraisers. Take an appraiser out to lunch. Nobody ever takes these guys out to lunch. If you do and you talk about different things and you become their friend, then whenever you need a cap rate, you just call them up. You say, what's a good cap rate for Midvale? What's a good cap rate for downtown Salt Lake City on this type of property? And they know that's what their business is. And that's one really good way to get it. But this one, we know the cap rate for comparable properties is 6%. That's a figure we need to know. We know that the gross rents are $10,000 and there's about $5,000 and another $300 in expenses. And of course, we already mentioned a cap rate of 6%. Now, the key on this problem is this is our formula. We have to do annual net income. Okay. Now, see the word net? Net means after expenses. Cap rate always are annual. Cap rates are always what? Annual. And so you've got to know that. And so what they'll do a lot of times is they'll give you monthly figures like they do here, and they'll give you gross monthly figures. We need annual, and it needs to be net operating income. So we take our 10,000, we take off the 5,000 in monthly expenses and the $300 in tenant improvements. It's kind of a sinking fund that you put money into, and that gives us a true NOI, net operating income, of $4,700, but that is monthly, and we need to be what? Annual on cap rates. And so what are we going to do next, folks? We're going to make it annual. So we take 4,700 times 12, which is annual, and so our annual net operating income is $5,600 and $400. And so now we can insert this in our formulas. And cap rate formula is income divided by cap rate equals the value. Okay, you need to know these formulas and you need to know how to move them around a little bit. Well, in this one, we've already figured the net income, was, what we have here. Is that the right figure, $5,600? Back up one. It's $56,400, wasn't it? Okay.
Yep. Guess we need to get that fixed.
Yeah. Okay. So let's keep going. Just stick that 400 in your pocket. No, I'm just teasing. Anyway, so you got $5,600, $400 divided by 0.06, the cap rate, and that gives you our figure of 900. And theoretically, that should have been 904, about $1 million, 940. And you might want to put a little bit of spread on there, maybe 959 or 949 or something, give you a little negotiating room. But as long as you sell this for right at that 6% figure, the cap rate, it'll be a tiny bit higher for the $400 difference. But as long as, we're just listing the property, okay? We're not appraising it. We're coming up with a figure we can put it on the market for. And so this is how you do that. So, befriend an appraiser, take them to lunch so that you can call them regularly and get cap rate and gross rent multipliers, and it'll be a real boom to your career. Okay. But you got to know the formula. You take your annual net operating income, divide it by the cap rate, and that'll give you the value, which is what we've just done here. And that was question number 3 and answer number A on your answer sheet. And we'll fix those figures. Okay. No big deal. We're trying to do the process here. All right. Now, here's another problem that's very similar. Another rate of return question. Okay. Remember, they call it rate of return primarily on the test, and they call it cap rate. They call it capitalizing an income. They all mean the same thing, same formula. P is a property that's making $3,300 net in annual income. Oh, hey, is this already net? Says so right there. Is it annual? Yeah, we don't have to manipulate that. Okay, at all. That it's the $33,000 is what we need. Their agent has found a comparable property that's making $40,000 annually and sold for about $1 million recently. So what should the agent recommend to his seller, P, as a listing price for his property? Okay, let's figure it out. What we're trying to solve here is the what? We want to know what the listing price might be. But to get there, we have to come up with a cap rate, in order to come up with a value. So we have an annual income, we have that, and we have a value of a comparable property, we have that. Okay, that was $1 million, right? So what do we recommend for a list price, guys? Well, let's just plug it in the formula and see how it works. Here we go. We have annual income of $40,000. We didn't have to manipulate that. That was just given to us. We have a value of $1 million. So if we take the 40,000 and if we follow the formula, the cap rate is about 4%. Not that bad, not that good either, but there are other reasons why you buy investment properties other than rate of return. But how do you know if that's a decent rate of return or a fair rate of return in your marketplace? You look at properties that sold and you figure out the cap rates, or you call your appraiser friend. Okay, so now we know what cap rate we're working with, and that's the 4%. So let's go back to our subject property. Our subject property had an annual income of $33,000, right? Was that annual? Yes. And was it net? Yes, they just gave us that. And we determined in this problem that the cap rate for comparable properties of that type of property is 0.04. So now we just follow the formula. We would recommend a listing price of around $825,000 following this formula. Okay. Kind of simple stuff, but on the other hand, if you're not really used to doing math, and that's one of the problems we have, you get out of high school, you get out of college, and you don't use math that much. Everything's figured for you, on your tax and statements and whatever by someone else, or maybe you're looking at your bank statement. The bank has all the numbers there. You don't have to do a lot of this stuff, but you got to get tuned up for the test. So let's look at another problem. Okay. So those are our 2 cap rate problems. Now this one has to do with square footage, or so what are we solving for? Well, okay, F is building a new home, and they've laid out the foundation 30 yards by 15 yards. If their home would be 2 stories, that's with the ground, ground level and a story above, and a 10-foot vaulted ceilings, how many square feet of living space will they have? Well, what we're looking for here is we want to know how big this house is going to be, square feet of living space. Now, many times in the math problems, they'll throw in something you don't need just to kind of confuse you. And that's the case here. The 10-foot vaulted ceilings don't have anything to do with anything, because we're not solving for cubic feet or volume in the house. What we're solving for is square footage. So we don't need the 10-foot vaulted ceilings. That's irrelevant. They threw that in there to kind of throw you off. The other problem that they've thrown in here is you need to be aware of the units here. And the units that we're trying to solve for are square feet, not square yards. And you think of the R.C. Willey yardsticks we used to get years ago, they were 3 feet. And so there's 3 foot in a yard. So if we take our 30 yards by 15 yards, okay, and it's 2 stories, we don't need the 10 feet. Here's what we're looking at. 3 times 30 is 90 feet by 15 times 3 is 45 feet. Now it was 30 yards by 3 because there's 3 feet in the yard, 90 feet by 45 feet. And now we need to know the square footage. So we take the 90 feet by 45 feet, and that gives us the square footage area of 4,050 square feet, but that's only for 1 floor. We have 2 stories here, right? So we just multiply that by 2, it's 8,100 square feet. Decent sized home, pretty big in most markets. I'd love to have that listing. Okay, probably over $1 million maybe in this market. All right, so what we're looking at here is we know that the living feet is, and that's our answer, 8,100 square feet. Not hard to get there. Just a couple of things. Watch for your units and eliminate information you really don't need. Okay, let's look at another one of these. Now here's a lot, and the lot's rectangular, meaning it's kind of square, not entirely square, but it's square-ish. Okay, it's rectangular. It's 200 feet deep, meaning from the front to the back is 200 feet. And the total area of the property is 42,000 square feet. How many yards of frontage does the property have? Now, these devious exam writers, this is kind of a flip-flop of the other one, okay? We've got the feet, but they want to know the yards. All right, well, the area is length times width, length meaning depth, times width, how wide it is, will give you your area. So let's work through this problem. We need the 200 feet, right? And we also need the 42,000 feet as well. Now, what we're looking at here is they want to know frontage, and frontage means that portion of the property that's on the road. So that's why you see the road here. It has the dividing line between the lanes. And so if the depth, what was the depth again? It was 200 feet deep. Okay, so the frontage would be let's go ahead and throw some numbers up here in the next frame. The frontage, then we have the whole area, which was 42,000 feet, and we know the depth was 200, so we divide that, and we have 210 feet. So 210 feet times 200 feet would give us the 4,200 feet. Okay, but we need to divide that by 3. Why? Because they want to know the answer in yards of frontage. Okay, frontage being that portion along the road, which is the other dimension we're working with here. So don't let things like frontage screw you up. It's just that period, it's just the length of the property that's on the street, frontage. Okay. Okay, pretty simple, as long as you know that watch your units, because feet are different than yards, and that 3 feet in a yard. And also you need to understand that occasionally they'll throw some number in there that you don't need at all, because we're not talking 3-dimensional. We're just talking about floor footage, or in this case, just the lot footage. Okay, cool. Are you enjoying your math? I hope so, because these are questions you'll get absolutely right, and that's kind of exciting. Now, different people have different attitudes about how to use the math or do the math. Some people say, because you're taking the tests on a computer, you can skip all the math problems and they'll bring them back all at once so you can enjoy them all at once. I don't know if I agree with that or not. It depends. I mean, I wouldn't want to, if you were a little bit of a math phobic, I just kind of take it as it comes. I don't want to save them all up so I can, obsess by that. And if you took too long to answer some of the other questions, you're going to get really hassled and frazzled, because, you've got a double whammy there. Well, I hate math, and also I'm about out of time. It's going to be tough. So I would just suggest taking them as it comes, but that's up to you. Okay. Now this one, H bought a property for a couple $100,000 with a down payment of $30,000. That's a pretty good down payment, on a $100,000 property, right? A 10% down payment would be 20,000. So this is a 15% down payment. Anyway, it's been making payments on their property for about 10 years. Now, 10 years later, their property is appreciated in value by 30%, and their current loan balance is $117,000. Okay. Okay, so if what is their current loan to value ratio? All right, so what we're looking at is what is it currently worth? What is their house currently worth? And what is the loan balance? All right, so we want to know the loan, because you'll need those in order to figure out the loan, their current loan to value ratio. How much of their property is equity and how much of it is loan? Okay, that's what we're solving for. So we need some more figures to work with here. Now we need the 200,000, right? With the down payment of 30. You know, unless you want to do that in your head, then you don't need it. But, you know, that's what I would do, you know, and so would just take it out. 10 years is irrelevant, and 10 years once again is irrelevant again, because we're looking for the current loan to value ratio. So the loan amount, they give us that was $117,000. We can throw that in the formula, right? And you need to divide it by the house value. Let's figure the house value out first. So if it went up 30%, all of it was 100%, but if it went up 30%, we multiply 200 by 130. You know, all of it is what you paid for which was 200 grand, and it went up 30%, so we multiply 200 by 130%. You add the 100% you paid plus the 30% in appreciation, and that gives us our current value of $260,000. Good number, we need that, okay? So let's continue to work on our formula here. So the next thing that comes up is we need to put our formula back up again. And they gave us our loan amount was $117,000. So we put that at the top, looking at our formula. We need to divide that by the current value, and that'll give us a ratio. Divide the one on top by the one on the bottom, and that gives us a ratio of 45% loan to value. See, if it was a 50% loan to value, it would be $130,000 to $260,000 worth of value. So that's about right, isn't it? You know, I mean, 117 is less than half of the 260. So it's about a 45% loan to value, which we look on our answer sheet, and that's answer A, and life is sweet. And we go to the next problem. C wants to get a loan, and he's trying to qualify, and due to their current credit, they can only purchase using a conventional loan with a maximum of 80% loan to value ratio. Now, a lot of conventional loans have an 80% loan to value ratio, at least if you want to avoid PMI. You know, and so anyway, that's pretty common, but they can make a down payment, $45,000. They have that saved, or maybe it was the proceeds of another house or other property they own, or maybe they just did really good in the stock market. I don't know. But what's the maximum value of the property that they can buy? Well, let's look at a formula here. Well, no, first let's look to see what the numbers is. We're trying to solve for value of the property, right? And what numbers do we need to do this? Well, we need the 80% loan to value. That's important, right? And we also need the $45,000 they have for down payment, okay? So if you have a loan amount divided by the home value, that gives us the ratio there. See, they're going for an 80% loan, so that'll be helpful. But if you have the down payment divided by the ratio, that'll give us the home value. Now, what was the down payment? $45,000. But 100%, you know, if it's an 80% loan, that, like I said, that would be a 20% down, wouldn't it? Okay. So our down payment was $45,000, wasn't it? And so if that represented 20% of the total value, then we divide that in. That was the down payment, and that means the home value was $225,000. Okay. You know, what screws people up on these is you're trying to use that 80%. The 80% that they gave you was only so you could get to the down payment of 20%. See, they want to know what is the ratio, you know, and that ratio between the loan that you can get, if $45,000 is your down payment, and that represents 20% of the whole value of the property, we come up with the whole value by dividing that number that it represents of the whole. It's called the reciprocal. But anyway, that's $225,000. These are good things to work with. Okay, this is stuff that you can actually use in practical application of real estate. And to get that license to get there, this would be a great problem to have. Let's look at the next problem, please. Here's an investor that bought a fourplex for 550 grand. It's kind of a duplex price in our market right now. I don't know. Although there are some fourplexes that sold over in West Valley for about 2 years ago. We sold one of them. They wanted to sell it as soon as they can realize a 20% gain. So at what price do they hope to sell the property? All right, they got into this fourplex and they paid 550 grand for it. So what did they pay for it? Well, that's all of it, 100%. They paid 550. That's what they paid, okay? And they say, well, when this goes up to a 20% gain, in other words, I want my 100% back to 550 plus another 20%. They want 120%, don't they, of what they paid for it? Well, let's look at our formula. Our formula shows us, oh yeah, well, let's highlight what we're solving for price, right? Okay, and we need to have the 500 and we need to have the 20%. That's helping us as well. All right, so the gain is or loss, we have the old value and then we have the gain or loss percentage. In this case, we're looking for gain, but things could go down the other way. It could have been a 20% loss as well. All right, so what we're going to look at is we're going to take the old value, we're going to divide that into the gain with the percentage gain, and that's going to give us the new value. All right, so let's look at this. Let's put some numbers in here. Percentage gain was 20%, 0.20. The old value was 550, so we divide the 550 into the 20%, and so that's going to go up to $110,000. And then does that make sense to you? The gain amount will be 110. Yeah, if they paid $550,000 for it, okay, what is 20% of $550,000? So it's 110,000. So you can kind of double check some of the stuff if you wanted to, but that's the gain amount. We want to know what it has to go up to in order for them to be willing to sell it. All right, so we need to do a little bit more calculation. We need to take that 110 in gain that they want and add that to what they paid for it. So when this property hits about 660, it's time to list it and put it on the market. And to make sure they get the gain they want, you might want to price it a little bit, just a slightly higher than 660, because they're going to have some costs from that and maybe some negotiating room. Okay, cool. This stuff really makes sense. The only way you really get good at this, folks, is to work practice problems. And we have a lot of practice problems that you could work. But once again, remember, this is only probably eight questions out of 80. So I wouldn't spend 3 weeks working on math. Get to the point where you can get at least 6 of the 8, or maybe all 8 of the 8. For those of you that are really good at math, you're wishing there'd been more math. Which, let's look at some more math. Okay. All right. Here's a homeowner that wants to move to a new city, and they know they're going to need a down payment of $80,000 to buy the house they want when they get to the new city. They're going to need an $80,000 down payment. They currently owe $215 on their current mortgage in the old city. If a real estate agent wants to help them sell their house, and the real estate agent wants a 5% commission, what will the sale price be of the home need to be in order for the owner to receive enough money for their down payment on their new house? So in a question like this, what are we trying to solve for? What is the sales price? What sales price will give this homeowner enough money to get $80,000 net so they can go buy their new place? Okay. Okay. Other things we need to know. We need to know that they currently owe $215, and we need to know that the agent wants a 5% commission. All right. So let's set our formula up and kind of work through this. First of all, if they need $80,000, You know that that's what they want. And they also want 215 to pay off their old loan. But in addition to that, you know, so that would mean they got to sell it for at least $295,000. But wait, there's more. We need to add on the 5% commission. Otherwise, they're not going to get their money. All right. So what we're looking at here is if we take all the money it needs to sell for and we take off your commission, that's 95%. Right. And so we're going to divide the 295 by its reciprocal, the percentage that represents of the whole. And what percentage is that? Well, that's 95%. Why? Because, well, we took off the commission. So if you take the 295 and multiply that by 5% and try to add that to the value, they're not going to get their $80,000. They're going to be short a few $1,000s. And they're going to say, I told you when I listed this house, we wanted 80,000. So that's going to come right out of your commission. You don't want to do that. So you have to divide in a commission. But in this case, we're going to divide in, that's what we want to solve for, is how much they need to sell this house for. At least 310, 527. So you'd probably list it for maybe 315 or 314.9 or something, in order for them to get this price so they can get their $80,000 to go buy their new home. Okay. So once again, you take what they owe, plus you take the 80,000 they want, and that would be 95% of what it needs to sell for, because you want a 5% commission. It would have been 94% if you wanted a 6% commission, wouldn't it? Instead of 95. Okay. If you were willing to work for 4% commission, it could be changed around again for that as well. So we look at our answers and we find that one and we take it and we move on to the next question. Okay, this next buyer has a has a new 40-year loan on their home with a total amount of $480,000, 4% interest rate. Taxes are $2,100. Are taxes annual or monthly? My gosh, they better be annual. You want to pay $2,100 in property tax every month? That's like another house payment. And they're currently paying $1,500 in insurance. Is that annual or is that monthly? Well, that better be annual as well. Okay, and so those are annual, and that's something you just know. And what will their balance be after the first payment of $2,500? Okay, now the key here is it's a brand new loan. Okay, so we don't have to deal with any amortization in paying off of that principal. They're not saying it's the 6th payment or the 9th payment or anything like that. It's a new loan. Okay, the total amount of the new loan is $480,000. So what we're solving for is the balance. We want the balance here. Okay, we know the loan is going to be $480 before the payment. We know they're going to pay 4% interest. We know the taxes are $2,100, and we know the insurance is $1,500. Okay, what will the balance be after that first payment of $2,500? Okay, well, let's work through this. Okay, $2,100 divided by 12. We're looking for the monthly tax figure, okay, because it gave us $2,100 for the annual figure. Divide that by 12. So let's hang on to that one. Now let's look at the insurance. 1,500 by 12 divided by 12. We want a monthly expense because the payment was monthly, wasn't it? That's $125. Now let's figure out what the interest was that they paid. Well, if it's a $480,000 loan, 4% interest, the annual interest due is $19,200 in interest. But we're not paying an annual payment, we're paying a monthly payment. So what do you think we need to do again? We need to take the 19.2 and divide it by what, folks? Keep going. By 12, right. Now, we know what the first payment was. Okay, they gave us that in the problem. But let's add up these other expenses here so we can figure out what the principal reduction did. It was a $2,500 payment. So what is a principal reduction? Well, let's take off these other figures. We know we have to take off the taxes, $175. We know we got to take off the insurance, $125. And we know we got to take off the interest for that first payment, $1,600. This is a PITI payment. So we take the $2,500, we take these 3 other expenses out of that payment, and that gives us a principal reduction of $600, right? So what do they want to know? Do they want to know what was the principal balance? Do they want to know what was the principal reduction or what was the loan balance? Remember, we're solving for the loan balance, so we're not done yet. We know the loan started out at 480,000 minus that first principal reduction of 600. So our answer, folks, is simply what? It's $480,000 minus $600. The new balance will be $479,000, $479,400. Okay. It takes you a little gyrations to get there, but none of this math is that complicated. You just have to kind of know your way through the forest in order to get there. Once again, if you just get, up to speed a little bit, you don't have to do calculus. You don't have to do statistical analysis. Really, all you're doing is arithmetic. All you're doing is understanding, you're going to either add, subtract, multiply, or divide. That's all you need to know. But you got to be familiar with the formulas, and you got to watch out for the little tricks like annual versus monthly, and that cap rates or rate of return is always net operating income, and it's always annual. Little tricks like that we've discussed in this video. Let's look at the next problem, please. Homeowners a monthly payment of $1,500, and their next payment includes $1,100 interest on a 5% loan. What the heck is their total loan balance? Okay, well, what are we solving for? We want to know what their total loan balance is. Before the payment or after the payment? Well, so we highlight that. We're solving for their loan balance, right? Okay. And we need the 1,100. They tell us that's the interest amount, and they tell us that the loan percentage is 5%, and they tell us their monthly payment is $1,500. Okay. Do we need the 1,500? No, because this question is not saying it's after the payment. They just want to know what their loan balance is before the payment. Okay, so let's set it up. Why are we taking 1,100 interest and multiplying it by 12 now? Because the 5% interest rate on the loan is not a monthly interest rate. It's a what? An annual interest rate. So that's why we're going to take this 1,100 on a monthly payment and turn it into an annual amount of interest that we're paying, which is $13,200 interest. Okay. Okay. So what's the next step? Let's hit the button. Well, what is this 1312? Where the heck did that come from? Well, that was the annual interest. And why are we dividing that by the annual interest rate of 5%? Because that is the same thing. One is expressed as a decimal interest rate, and the other is expressed as the amount of interest paid. So to determine what the principal balance is, the loan balance, which is what we're trying to solve for, we want a dollar figure. We divide the annual interest by the annual interest rate, and that's going to give us our loan balance of $264,000. Okay. You learn by doing in math. You need to work some of these, but as you work through them, you're going to find out that, oh, okay, that's not as difficult as I thought it would be. Okay. Now, sometimes, if you're really stumped on some of these things, you can look at the answers and work them backwards. Sometimes that works well too. You find the answer. One of the answers is 264,000. And you divide that by 0.05 in order to get 1,300. And that, so actually you're kind of working it backwards, aren't you? Okay.
It's kind of one of my favorite ways to do it. If I can't remember the formula, I'll just work stuff backwards until I figure out what matches.
Yeah, we don't care if you go forward or backwards. It doesn't make a difference to us, as long as you get the right answer. And don't screw up our passing rate. Okay, we want you to pass. Okay. Okay. Do we have some more we're working on here, Dan? Are we going to work some? Yeah,
I think that was the last one.
That was the last one. Okay, good. We really appreciate you being here tonight, and we're not going to turn you into a math savant. We don't need to. Just work some of these problems. You can do this. I know you can do this. And if you run into trouble, just call for help. And we have more math problems that you can work, and we can work some of these with you on a Zoom call, another Zoom call, and a one-on-one Zoom call. Happy to help you any possible way. Okay. So good luck out there. We're entering into a very interesting time in the market where you can actually do really, really well. Good realtors make more money in down markets, guys. And we're entering into a market where we're kind of be a little bit of, the little bit, prices might come down a little bit, interest rates might go up a little bit. Um, it's going to be fun. So thanks for being with us tonight. We always have your best interests at heart. Give us a call if we can help.